Welcome back everyone to Don't Fear Finance. Today we'll look at a broader topic than last week's video. It is, what is the most harm you can do to yourself in the stock market? By this, I mean, what will lose you the most money? How much can you miss out on due to these mistakes? How long will it take to make up for these mistakes? We'll look at all of these topics today. No bullshit, no content asking you to destroy the like button and subscribe button, but it'll be really appreciated. Now, into the video. When you think of this topic, it seems intimidating. We're talking about what could be devastating mistakes with your money. But on paper, it boils down to the following 7 mistakes. It all starts with, number 1, no basic knowledge. Knowledge is power. That is the saying of this industry. If you don't have any basic knowledge, then you will invest in something stupid and lose money. You won't know what times to invest in the market and what times to pull out of the market. All of these problems and needs are fixed with knowledge and intelligence within the niche or market you're investing in. It's like starting a business. If you don't know what the hell you're doing when you start your business, it's going to plummet because you have no clue what to do when the first problem comes up with your product, service, or market. Before you even invest a single penny in the stock market, you should research how it works and what time people invest in the stock market the most. When you're doing your pre-investing research, then I would recommend that you find what stocks have the most fluctuation in stock price and value. For example, Tesla. In the short term, it goes up and down in value. If you look deeper into the actual stock though, and its history, then you would realize that by letting your money grow with that stock, you could get a lot of value in the long term. Number 2, short-term trading. Stocks and the stock market in general are crazy. It's like the S&P 500 but on G Fuel. There will be times where it will be doing insanely well, then there will be times where it will be doing horrible. If you go into the stock market thinking that you can make some short-term profits, you're in for a real surprise. The stock market, in a way, wasn't made for short-term profits. The stock market fluctuates in price all the time. Each stock is different. No guru can predict short-term profits, and they know it. If you aim to get short-term profits by buying into the stock market, then you could lose out on nearly 5% of profits compared to people who just stayed in the stock market for long-term gain. The average person who buys and sells at risky points where they believe that they can get themselves the most profit earns about 3.1% compared to people who stay in the long run. These investors earn about 8.7% profit. That's a massive loss for people who buy and sell for short-term profit. This is because they would be missing out on the best 50 days in a 30-year span, which is about the average time an investor lets their money grow. Don't pull out of the stock market for short-term profits. It never ends up well. Number 3, has not diversified risk. I've mentioned this in a different context in an earlier video, and it means, in simpler words, don't put all your eggs in one basket. You could also say that you are spreading yourself thin, which is good when you're investing in the stock market, but not when you're in business. Industries are unpredictable, and concentrating your portfolio is super dangerous due to the fact of the unpredictableness of profits and gains. Take the travel industry, for example, and the online industry, for example. When the global pandemic occurred earlier this year, everyone had to stay inside. They, of course, couldn't travel. This meant that the travel industry couldn't make any profits, making a huge dent in their business. On the other hand, a company in one of the online industries began to blow up due to the fact that people were inside and weren't able to go to shopping malls. They had only one place to turn to, online shopping businesses, of course. Take Amazon, for example. It was already doing incredible with profits and growth and increase of value, but when the global pandemic struck, they began to have more and more sales and profits. You see, if you only invested in the travel industry, then you would have lost a lot of money in the last 8 months. But if you invested in the entertainment industry, the travel industry, and the online shopping industry, then you would have lost money, but not all the money you had invested. And some would have even increased. Number 4, buying shares on credit. Buying stocks on credit just means that you're buying something risky with debt. Usually, experienced traders will use this to buy stocks with banks or brokers' money. When the value increases, they cash out, pay off their debt, and cash out with the profits they earned. Now, they do this for a living, and if you are an inexperienced trader, then this would be a very risky thing to do due to the fact that you have very little experience, and the majority of the time, you have very little money to spare. If you invest in a poor performing stock, then you could lose a lot of money that you would have trouble paying off. Most of the time, experienced traders have years and years of doing this under their belt, but they do lose money doing this. Most of the time, they have money to spare to pay off their debts and interests. Now, if you're investing in the stock market, then investing with this method is very unwise if you are a beginner investor. Number 5, following recommendations blindly. If someone tells me that they followed some recommendations for investing without looking into it, then my head automatically hurts. There are countless reasons for this. First, it's so much better if you know what you're investing in due to the fact that you've researched how risky it is, how it fluctuates in price, when to invest, and so much more. Another reason is that people will say anything to get attention and money in their pockets, and also the fact that people can be dumb with the information they gain. They don't look deeper into what they find. Please, before you click off of this video, I want to let you know that everything I say here is to my knowledge, is true. Take what I say with a grain of salt though. Please, if you're enjoying the video, like and subscribe so I can bring you content and knowledge that you won't be able to get anywhere else in school or mainstream media, and you'll also get a photo of a puppy. Continuing with my point, I would recommend that you invest in the already proven stocks that work if you are new to the stock market. This includes Amazon, Apple, Netflix. Make sure that what you're investing in is diverse. And always research before investing and taking advice from random people, including me. Number 6, not setting stop prices. In the stock market, you should be able to handle quite a bit of loss, but you should always be able to have a point where you pull out your losses and move on. When you invest in the stock market, you should have a strong threshold for loss of money, but as I said before, there should be a cutoff point of how much you've lost. If you keep losing money in a certain field of stock, for example, the travel industry, then pull out and accept the losses. This should be the cutoff point for all of your stocks and investments in every field, no matter their prior performance. If the value of the stock or investment doesn't go below the cutoff point, then let them try to redeem themselves. This is what long-term investors have learned to do and do all the time. This will save you lots of money and heartbreak from painful losses. All your stock values rise, then you should make the cutoff point a higher value. Number 7, trading without strategy. You should always have a plan for investing and never, and I say never, invest with your emotions. It will just make you lose money. Fear is the main emotion you should never listen to, the majority of the time. Keep in mind that having no fear of losing money is also a bad thing to have whilst investing. You should always have a plan for where your money goes. Keep this in mind every minute of every hour of every day that you invest. Once you make an investment or a change in your investment portfolio, do not change it. I say this due to the saddening fact that investors who change their portfolio for show and bling lose an average of 1% of their earnings each quarter if they hadn't changed anything in their portfolio. These losses can even accumulate to 3%. There are 2 basic strategies for when you invest in stocks. Number 1, value investing, meaning how much value will this stock gain or lose in the near future? Does it have a history of poor performance? Number 2, diversification. This comes back to having many different stocks in many different fields in the stock market in case one field does poorly one quarter. That sums up this quite broad topic, friends. Thank you guys so much for watching. I really appreciate it. Make sure to like and subscribe if you want more of this type of content, and I'll see you in the next video.